Hello and welcome to the show. We are so glad you could join us tonight. And if you've been watching the news, there's been no shortage of big economic news of late. We've had the latest Fed minutes suggesting policymakers are more than happy to sit on interest rates for longer. Greece is looking for an extension to its European loan. And on top of that, market watchers are trying to figure out what the bottom is for crude prices. And on top of that, CEO after CEO has been talking about the impact of a strong U.S. dollar and what that has meant for their bottom line. And for U.S. companies, the bottom line is it's not good. So what does this mean for your portfolio? Here to help us put it all in perspective, one of our favorite guests, David Pearl. He is Co-Chief Investment Officer and co-founder of Epoch Investment Partners, and he joins me from New York. It is great to see you, David.
Great to be here.
Okay, now a whole lot has happened since I've talked to you last, which I think was a few months back. So I guess let's just start there. I mean, let's just say we talked 6 months ago, fast forward to today. How much has the world changed?
Well, the U.S. Has gotten a lot stronger. It is in a sustainable recovery. Over the last 6 months, employment numbers have actually increased. There is no doubt consumer spending has benefited because of the drop in oil prices, particularly in dollars. So U.S. being a consumer-driven society, the economy has really started to pick up. That has strengthened the currency. And relative to other geographies, looking at Europe, which has been skirting with recession and even deflation, Asia slowing down, at least from faster growth. The U.S. is a great place to be, so money has come in. The stock market did go up in the U.S. last year, another double-digit year. And so it has been a particularly good period for equities. Surprisingly, yields should have gone up at the end of quantitative easing, but they actually took a dip down, probably because of foreign buying of U.S. securities. For instance, why would you own an Italian treasury that yields less than a U.S. treasury? So that effect has brought a lot of money back into U.S. bonds, although in the last few weeks, the yield curve has begun to rise a bit, and the 10-year has gone from a low of 1.5% or so to 2%, which is a significant move.
Yeah,
so normally, in a recovery, we would see rates starting to rise. So, we're starting to see a more normalized environment.
Now, I know you spend a great deal of time focused on the U.S. economy and U.S. equities. And, all that strength in the U.S. economy, just makes the U.S. dollar go even higher, quite frankly. It's something that's pushing higher. And we heard, I know this is an issue that you're watching closely, is the impact of the strong U.S. dollar on these companies. It's an astounding number, actually. I think P&G talked about how it's the biggest currency impact they've ever had. McDonald's said 9% of earnings in fiscal 14 was going to get hit by currencies. DuPont said I think it was 15%. I mean, these are staggering numbers. So how do you weigh the strength of the U.S. economy with the fact that many of these U.S. companies are multinationals and they're deriving their business outside of U.S. borders?
Yeah, no, it's a very important factor. We have to weigh in how much of currency is just translational, just the effect of changing euros for dollars, or it is transactional. If you have a factory outside the U.S., you can benefit. So there are definitely companies who actually benefit by a stronger dollar. Certainly domestically oriented companies benefit. One of the effects of the last 3 years of quantitative easing has been the largest companies have outperformed. Those tend to be those multinationals that have more of a currency hit. So we do think there's more opportunity in small and mid-cap stocks relative to the largest stocks at the moment.
What about the state of employment in the U.S. economy? I mean, again, I'm domestically focused, or U.S. domestically focused here, but I know you've talked about the fact that in your outlooks that employment is right now above pre-financial crisis levels, and that is a positive. On the other hand, not seeing a lot of wage inflation.
Yeah, that's correct. It only took, let's see, 5-6 years to get back to where we were before the financial crisis, but we are higher in employment. The problem has been wage increases. You really want to see that. When you think of consumer spending, confidence is a function of whether you have a job and whether you think you're going to make more money. And so the job picture is better, but wages have been nagging. We are seeing structural changes in employment. just like 30, 40 years ago when factory workers were displaced by machines, service workers are beginning to be displaced by technology. So, you know, whether it's a waiter being replaced by a tablet in a self-serve restaurant, or even perhaps a bank teller at some point by a self-serve kiosk, we're seeing service workers have excess employment, and wages therefore are not growing. So this could be a very protracted recovery in wages. Without wage growth, it's very hard to see inflation. And without a lot of inflation, the Fed in the U.S. is not in a particular mood to raise rates. Witness today's Fed minutes. They're pretty dovish. So rates could be low for a long period of time, but they're clearly more likely to go up than down from here. It's just a question of how fast and how much.
So when you paint that landscape, David, tell me, you know, in the next segment, we're going to be talking about companies that you think are the most attractive in this kind of environment. But before we get to the names, could you just outline for me what attributes these companies have that protect themselves against this environment that you're talking about?
Oh, sure. You know, so again, as I said, the last few years, the market was led by the largest companies who happen to have low volatility because they were kind of defensive, whether it was consumer staples, telecoms, utility stocks. In fact, they almost acted like bond proxies. They had a big yield, they had low volatility, and they benefited by the lowering of rates by quantitative easing. Those stocks have hit real highs. Utilities are at all-time highs historically, whereas economically sensitive stocks underperformed, and that would be industrials, technology, consumer discretionary stocks. So even though the U.S. stock market has done very, very well, although in large part because of valuation increase, the PE of the S&P 500 has gone from 11.5 times earnings to almost 16.5 in the last 3 years. So more than half of your gain was from valuation. The valuation was not evenly distributed. The defensive large cap stocks got more of the valuation increase. So there's really an opportunity for stock picking in the economically sensitive areas. And of course, what I'm saying is we're in a recovery. So if you believe that the U.S. is in a sustainable recovery, you should be buying economically sensitive companies where there'll be revenue growth from consumer demand, driving earnings and free cash flow growth. Financials should benefit because there'll be more demand for loans. And one of these days, the yield curve is going to steepen, and they're going to be more profitable. So financials are another group that should benefit by economic recovery. And again, they're at depressed valuations relative to defensive sectors of the economy.
All right. Well, there is the thesis from David Pearl. He is Co-Chief Investment Officer of Epoch Investment Partners. In just a moment, we're going to come back, continue our conversation with David, and talk about which names specifically he does like, given that background he just painted for us. So stay with us when we come back. Any reminder, any comments or questions, we do love to hear from you. Send them to MoneyTalk@bnn.ca so we can get them, answer them for you on the show, or find the right person to answer them for you. More Money Talk when we come back. Welcome back. We are back with David Pearl, Co-Chief Investment Officer of Epoch Investment Partners. He joins us from New York. And David, just before we get to some names that you think are interesting, I want to bring up a chart that you've passed on to me. This is a look at the performance of the last 3 calendar years of the S&P 500 on the left side of the chart for those that can see, and total return on the MSCI World Indices, 54%. So clearly much higher returns in the S&P 500. And I'm going to be assuming this is all about QE on the U.S. on the side of the U.S. markets.
Right. The thing to take out of it is when you're an equity investor, you invest in a stock, you own a company, the only way you get your return is that your company generates profits. They're your profits as a shareholder. They may pay you back some of that money as a dividend or maybe a share buyback. And then the last thing is the valuation of the company fluctuates. If you look at that chart, more than half of your return over the last 3 years, and it was a great return, came from valuation increasing. The S&P valuation went from 11.5 times earnings to 16.5. So, the tide lifted all boats. As I say, it was a little more beneficial to dividend yielding stocks because of QE. It was that search for yield forced investors to buy particular groups. But nevertheless, what we're saying going forward is we don't think there's that much room for PE expansion, particularly if rates rise. They're very correlated. Basically, valuation is the future value of a dollar of earnings, and when rates are low, the dollar's worth a lot 5 years from now, but when rates are high, you discount it back not so much. So PEs are probably going to be flattish going forward, and your return is coming from earnings growth. We like to look at free cash flow growth, and then all return of capital to shareholders. That's what fundamental stock picking is about, finding companies that will grow their earnings more and do the right thing with our cash to help shareholder value creation. And in an economic recovery, we think it's going to be beneficial to own the more cyclical or economically sensitive groups. So that's what we take out of that chart. It was a wonderful time. People wanted a 4% dividend. They got double-digit returns. It's now going to be a little harder to get great returns. We're thinking more like high single digits, low double digits, if you can find a company that can grow their earnings. That's going to be key going forward.
All right, so that's the screen through which, for our viewers, David is taking a look at the names. We've got about 3 minutes here, David. I want to get to some of these. One name that you like right now is AIG, which, if I'm not mistaken, Japan is a pretty major market for AIG, is it not?
No longer. They sold that operation,
okay.
So they're a domestic company now. They were in tatters after the financial crisis, but they have rebuilt the company, and they generate a lot of cash. They're going to be buying back 10% or more of their stock over the next year to 2 years, and they're selling below their book value, so it's incredibly accretive to buy their stock back. And they benefit tremendously by economic growth, because the property and casualty business benefits when companies are buying more and more equipment and have more buildings, so there's more P&C insurance. And also a steepening yield curve would be tremendous for them. Once again, can't tell you how soon that happens, but that's all upside, and the stock is cheap historically, cheap versus financials, and cheap versus the S&P. We don't like to use book value that much as a metric, but it's selling below book value, implying that people really don't even believe that their assets are that valuable. But they do, and they have lots of cash to buy their stock back to prove it. So we think it's going to be a very, very good stock over the next couple of years. All
right. Let's take a look at another name here, Hexcel Corporation. And just again, for Canadian viewers, tell us a little bit about who they are.
Yeah. Hexcel is a mid-cap stock. They supply the carbon fiber that is used in the bodies and fuselages of the Boeing 787, the new fuel-efficient Boeing plane, and the new Airbus A350. The A350 is just going on sale, the new version, so they have tremendous demand growth because of the backlog of orders for these two new planes around the world. And the amount of content in each plane is significant. In fact, Airbus is more than 3 times as much as Boeing, and the stock has done very well on the backs of the Boeing 787. But for the next few years, you add the A350, they're going to have tremendous revenue growth and improving margins, because it's a story where they spent a lot of money in CapEx, and now they benefit by operating leverage as more and more volume of carbon fiber is used in these planes.
Yeah, so these are these companies, I know we've spoken before, that have spent the money to invest, to get things going, and now they're reaping the benefit of those investments they've had before.
And it's a great environment to sell planes with economic growth, low energy prices.
Yeah, that's a little less to fuel a plane than it was not too many months ago. Yeah. Let me ask you about the last one, Microsoft. Interesting, because Microsoft, I know you've been holding Microsoft for a while, but the last earnings, I think, were a little bit underwhelming for some people.
Yeah, Microsoft had a one-time benefit for the last year of the end of life of Windows XP. So most enterprises had to buy new computers for the last few months using Windows 7 or a newer operating system. So that effect it basically ended last quarter. So for the next quarter or two, they have to lap this one-time effect. But the reason we own Microsoft is that 2/3 of the business today is enterprise. People think of their PCs, their laptops. That is not that important any longer. And in fact, we would say it has a negative valuation, the consumer business
really?
For Microsoft. The enterprise business, they are the second biggest cloud operator already, and they are growing at over 100% year over year in cloud services. Their server business is double-digit growth, and they've done things like turn packaged goods sales into subscriptions and licenses. Think about Microsoft Office. You can no longer buy it, you rent it. It is a subscription service for $100 a year, and it's been tremendously successful in enterprise and consumer, because basically you always have the latest version as long as you pay the subscription fee. So they've turned the business into a better, more consistent business, and enterprises still rely on Microsoft. There's upside if they figure out how to make the consumer business better. We think Windows 10 will certainly be helpful, but there might be a case where they spin off or sell some of their consumer businesses, and we think the margins would actually go up for the rest of the company. They generate $4 a share in free cash flow, and it's only at $43 a share, almost a 3% dividend. They're buying back stock in addition, so we could see this stock up 50% over the next couple years by just working at increasing the cloud and enterprise services and just fixing some of the issues they had with consumer, or in fact spinning it off.
Well, that was my last question. I was going to ask if they were going to spin it off, and we're just going to have to wait and see. David, such a pleasure. Please join us again real soon.
Thanks.
David Pearl joined us from New York. He is co-founder and co-chief investment officers at Epoch Investment Partners. All right.